So thank you very much. We now proceed to, as already announced, to another important question of what have we learned, what are the lessons, in this case not of macro-PRU over the last many years, but lessons from quite recent banking crisis. It is clear that everybody noticed that beginning of this year, it looked like we might be in for another round of dominoes collapsing with banking crisis, starting in the US and then Switzerland, and then it stopped, thank God. So we've had time to draw lessons, and I have with me here a fantastic panel. I have myself also been part of drawing lessons for the Swiss case, and I'm happy to contribute some of that later, but let me give the floor to the panel first. And they should be all extremely well known to you, but I will therefore introduce them not with all of their life achievements, but with their CEPR hats. So, because we have here a full panel of CEPR leaders and heroes. Yes, Elena Carletti leads one of our most important program areas. Banking and corporate finance is something we split into asset pricing, and the one Elena has been leading for 2 years now. Mathias Dewatripont is one of the heroes of CEPR. This is an official title. He has a badge. He has a badge to show it. For it, this is awarded to a set of our funding fathers who have been with CEPR and building up CEPR over the last 40 years. And Patrick Honohan is another, long-term friend, fellow, and of CEPR, and also one of the trustees of CEPR. So one of my bosses in that capacity. And finally, last but not least, of course, Richard Portes, the superhero and founder of CEPR. So all of them are working on what can we learn from banking crises, and they each have 10 minutes to start their presentations, and then we have a discussion with the audience. Elena, you want to go?
Okay, we were wondering with Mathias that we have one microphone. I don't know if you want to give us another one or... No, that's the problem. Okay, so first of all, good afternoon to everyone, and thanks for having me on this panel. So what I thought of doing just as an introduction was to really scratch the surface a little bit of the discussion that we may have, and I'm sure some of my colleagues on the panel will actually go more into the details. But I just want to start from looking at 5 different phases of what happened, both in the case of the SVB and Credit Suisse, and from there just to give an input of what lesson or what at least thought one might derive from this event. So let me start where actually Gaston ended, which is the environment and the sudden spike in interest rate. As he also said, clearly, we saw with that a very close interaction between monetary policy and financial stability. I think it's fair to say, yes, banks should have seen it, but probably such a steep increase in rates was very largely unexpected. And of course, this raises the question of the relation between monetary policy, financial stability, and macroprudential policy, to which extent the decision on monetary policy can be unrelated, or to which extent it should take into account the implication for financial stability. And we heard already Gaston says, of course, macroprudential can help here, but maybe the internalization of financial stability in monetary policy is also something to reflect upon. The second one is instead more prudential regulation. Of course, Credit Suisse maybe was not part of it, but in the case of Silicon Valley Bank, it's fair to say that we had the deregulation wave in 2018. We had the mid-sized banks that were excluded from Basel III, in particular the LCR regulation. And not only they were deregulated, but also there was no more information flows, or at least not constant information flow between the banks and the central bank, which clearly raises the question of deregulation, and if we look at the financial history, it's very typical the case that we have a tightening of regulation, after a while a deregulation wave, and then a crisis. So this cycle is very typical, and this has happened again for the situation of the mid-sized banks. Clearly, the expectation, I guess, when deregulating this group of banks was that they were not systemic enough. But then when the crisis came, it was very clear instead that each of them in isolation would not be systemic, but as a group, they were actually systemic, which raises the question of the definition of systemic banks. So how do we define them? Several years ago already in academia, we were talking about too many to fail as opposed to too big to fail. And maybe that's one of the case in the case of the Silicon Valley Bank case. The third point, the third stage, and I have 5, so it is a middle point, is that I think it's fair to say both banks had the problem for some time. These are not banks that out of the blue, they start having problems overnight. On the contrary, Silicon Valley Bank had already some issues, and we knew that the business model, the banks had a business model that was really not sustainable and clearly not sustainable, with this very predominant investment in these very long assets with interest rate risk coupled with the liability side, and in particular the concentration of uninsured depositors that it had. So it's fair to say this was poor risk management, poor risk internal culture. In the Credit Suisse case instead, it was different but similar in a sense that also Credit Suisse had for the last 2 years clearly signs of problems. It had made big losses in the case of Archegos, in the case of Green Seal. It had accounting irregularities, a serious governance scandal. So these are not banks that somehow were fully solid, fully well managed, and then suddenly they enter into crisis. Which raises the question that also Gaston said at the end of supervision. So where was supervision? How can we improve supervision? And I know some of my colleagues will say that supervision cannot see those issues and cannot foresee everything, and therefore we need the capital. But I think it's fair to say in this case is actually supervisor saw something, but there was not the second phase, so they detected the problem, but they didn't enforce enough corrective actions. So here is, I was last week at the SSM conference, and I had in mind a speech that Andrea Enria gave recently in one of his interventions in the last month, and he was making the distinction of the 3 phases of supervision. We have preventive supervision, detective supervision, and corrective action supervision. And while the preventive is closely related to regulation, the detective and the corrective action are the areas where certainly supervision can and should improve further. So that's another lesson, I guess, for supervision. And then if we look at what instead triggered those crises, so 4th phase, in the case of Silicon Valley Bank, it was clearly the sale of the IFS securities that generated almost 2 billion losses. This raised the question, of course, of accounting, so historical cost accounting versus available for sale, hedging of interest risk, not hedging of interest rate risk. If we look at the US and Europe, there are striking differences in this respect. US banks hedge the available for sale security only. They don't hedge the historical market account. This is due to an accounting rule under GARP rather than the IFSR. In Europe, banks tend to hedge both the HTM, historical, held to maturity security, and the available for sale. But I think here, and we had this morning, actually very interesting paper from Pascal Paul of the San Francisco Fed, where they were showing that US banks really hedge very little. Even on the available for sale, they hedge 50% of the security they hold in their book. So I think here, yes, we can discuss capital, but I think here there is an important angle that comes from accounting. And for the people that are closer to the working of the banks, those people realize the importance of accounting principle in banks. It's not just a matter of capital regulation or whatever, but it's really the accounting side that matters a great deal. And in the case of Silicon Valley Bank, and in general, US bank versus Europe, I think there is something to reflect. Then, of course, there is the issue of the sudden massive deposits that were taken away from Silicon Valley Bank. This raised question on the LCR, the liquidity coverage ratio. Do we have the right weight when calculating what are the liabilities that are stable rather that are not stable and so on? There are discussions, but I think it's worth saying that differently from capital, all securities in the calculation of the LCR, whether they are held in the available for sale or in the held to maturity, they are all valued at market value. So at least we don't have an issue about unrealized losses on the side of the liquidity coverage ratio. How many minutes do I still have? Did you look at me? Okay. Last, what was done? So we know very well the Silicon Valley Bank was taken over by the FDIC after the bail-in of junior bonds and the share and the use of systemic risk exception I mentioned before. Credit Suisse, we all know it was acquired from UBS, still in going concern, not a resolution. So that, I think, raises the question of whether the resolution apparatus is really implementable or not. We can have different views. I think, and I'm sure that also Beatrice will have a lot to say about this, I think one maybe obstacle in that was the application of bail-in. I think that I was reading that they should have converted the 40 billion of subordinated debt into capital. That was legally not very easy. So I think this raises the question of how we apply the resolution. But let me stop here.
Thank you very much, Elena. Right over to you, Mathias.
Well, thank you, and thank you. It's an honor to be here in this panel and this great conference. So I'm very happy. I guess we agreed earlier with other participants in the panel I would focus more on Europe. Of course, starting a bit with a comparison. So maybe I'd like to make as first point a very quick comparison between the US and the EU. As was said earlier, we had problems in Silicon Valley Bank and other US banks. We had problems in Credit Suisse, and we didn't have problems in the Eurozone. So I think the ECB, the SSM, should be applauded for that. I think that is, good. That's a good news. I think, frankly, praise should also go for EU regulation, which applies Basel III rules to many more banks than in the US. In the US, I think it's at most 20 banks. For us, a $100 billion bank is very significant. We go much below. In fact, it's a consequence of our ever closer union that we apply a Basel III to every bank, even the corner bank. That has prevented, I think, that's one reason why we didn't have Silicon Valley Bank. On the other hand, I think, frankly, Credit Suisse is more worrisome. They were under Basel III. When we look at our GSIPs in the Eurozone, well, they don't look great in terms of market capitalization if we compare to the big US banks. I think some of them look miserable, if I may say so. And I think there may be a connection with the fact that we still are, I think the EU, the only jurisdiction that is not Basel III compliant. The second worst is the US, but they still pass a little bit the test. So I think that we should apply it more seriously. I think we are also, in contrast to the US, much more tolerant for the use of internal models of banks to reduce capital requirement. My understanding is like in the US is not allowed to use your models to reduce your capital requirements. And so I think it shows that some of our GSIPs could be fragile, and we have to think about that. So that's point number one. Now, in terms of what to do, and Elena started a bit on this, about you know, supervisory effectiveness versus versus more rules, more capital, more liquidity. I do think that it's true that rules that look strict but aren't really, because in particular accounting numbers move too slowly, can give a false sense of security. So that the advantages that economists like to put forward of rules over discretion, in this case rules over principles, is worth thinking about, since this false sense of security can be an unintended consequence, as supervisors say, about this. On the other hand, rules are needed to give a legal basis for intervention. And one clear lesson, I think everybody will agree on that, is that we should also strengthen the rules, in particular by introducing market-based rules and not just accounting rules. However, I think that will have consequences for some of the GSIBs I was talking about in the Eurozone. So I think that is needed, even if, as Elena says, there is more market-based accounting in some cases in Europe when looking at available for sale, for example. Now, I think that we need to do both, strengthen some rule and improve them. And it is true that there is more than capital and liquidity, and sustainable governance and sustainable business models have been mentioned by various people. And in this respect, I think we may want to go back to these debates we had at some point in the UK, in the EU, in the US, about structural measures. In the UK, they had the Vickers report, and they decided to ring fence retail activities from contagions from investment banking. There was a Liikanen report, which I'm afraid our dear universal banks managed to kill, if I may say so. And we may want to think about that. I think, are we really fully confident about the business model of some of our Eurozone GSIBs in these dimensions? I do think these topics deserve some re-examination, also because it's connected in a sense to the link between shadow banking and banking, which is not supposed to be as important if you read FSB ideas that we should have really a disconnect between the two. So I think that is an interesting point. On the other hand, I think that the EU has been creative through the European Parliament in introducing limits on remuneration of management. So variable compensation of bankers in the EU can be at most 100% of fixed compensation. By the way, that's one thing that the UK has eliminated just after Brexit. Now, I don't think it's the most optimal way of doing things. But I do think in a world where beyond banking, everybody is talking about the excesses of shareholder capitalism, shareholder value in non-financial sector, allowing for shareholder-based or stock option-based remuneration in a sector which is the sector with the highest leverage of all the sectors in the economy. While we all complain about leverage, does that make sense? And in a sense, thank you, in a sense, while going for much higher capital ratios would be costly, admittedly, changing the remuneration, the link between management remuneration and stock price value would be much cheaper. So in that sense, I think it's worth thinking about. Now I have only 1 minute left to talk about the final point, which is resolution. resolution. We had the opportunity with André Sapir and Peter Pratt to talk about it a bit in two Vox EU columns. We are clearly not ready in the EU to face an EU equivalent of Credit Suisse. Or BRD 8% rule is just not possible, not workable if we don't have 8% of subordinated funds. We definitely don't want a new Lehman, so that was great, the way SVB, Credit Suisse and the like were dealt with. But clearly there is work. There is, of course, an interesting proposal by the Commission, Crisis Management and Deposit Insurance, CMDI. I think we should do it because it allows easier resolution. We still have this problem of cross-border. In a sense, prudential authorities in Switzerland were very lucky to have a UBS, a Swiss bank, ready to take over Credit Suisse. Now, I'm not talking about the interest of the consumers, the bank customers, but the prudential authorities, yes. We have 4 countries in the Eurozone with a single GSIP. What happens if one of them is in trouble? I think, at some point, Commerzbank was up for sale. ING, Dutch GSIP, said, I'm interested. They felt compelled to say, look, but if we do it, we will move our headquarters to Germany. So we are not really in a European market. We are still in a set of national markets, and I think that has to be dealt with if we want to be ready for resolution. Thank you.
Thank you, Matthias. Over to you, Patrick.
Thank you. Thank you for having me on the panel. I just use a few slides, so I'll come up to the. Look, I'll focus my remarks on how the authorities dealt with these failing banks, crisis management. Well, they were not ready, and it shows. And I think this tells us something about the degree to which all of the work that has gone into the strengthening of the policy regime for dealing with failing banks over the past 15 years, the degree to which it's been effective. So not as effective as I think we hoped. So I'm going to tell you that in each of the 4 main action areas of failing bank policy, what happened in early 2023 reveals significant weaknesses. Now, I'm not focusing on the policies that were used in the end, but how well prepared the authorities were and whether existing policies and practices caused this lack of preparedness. So the 4 main action areas, tools, if you like, are supervisory intervention, the distinction that Elena has already made, emergency liquidity, deposit insurance, and resolution. And the common feature here is lack of preparedness. The relevant authorities on both sides of the Atlantic were not ready to take the necessary actions. In 2 of the areas, I'm going to say that the shortcoming relates to legislative arrangements or standing policies. And in the other 2 cases, seemingly a lack of self-confidence or proactiveness. So take supervision. Now, in the case of Silicon Valley Bank, we have the excellently granular report of Michael Barr on why there was insufficient corrective action in respect of SBB, even after clear wake-up calls had been sounded. And I'm afraid that that report shows that the practice of bank supervision in the United States has accumulated an elaborate, legalistic superstructure of procedures that slowed corrective action. It's an inward-looking, I like the word, scholastic approach to supervision that has had fatal consequences in effectively choking what should have been a vigorous response, given the growing evidence available to supervisors half a year in advance that SVB was heading towards failure. Instead of intervening strongly with the firm, the supervisors analysed and debated among themselves. They debated about whether to downgrade the assessment, official assessment of SVB's sensitivity to financial market risk from satisfactory 2 to less than satisfactory 3, so that the supervisor was not ready to act with sufficient proactive vigour was the main reason for this failure ending as messily as it did. And I'm afraid that the Fed is not the only supervisor whose practices are unduly constrained by rule-based procedures. Matthias has already touched on that phrase. And indeed, we saw a lot of this before the global financial crisis. On emergency liquidity, here again, in Silicon Valley Bank, we had a bank closing its doors midweek, well, it's not exactly midweek, but towards the end of the week, because it had not made the technical arrangements necessary to access the fund's facilities sufficiently quickly. As a result, the Fed was not ready and able to provide liquidity that apparently it would have wished to. Indeed, within days, the Fed introduced a remarkable new facility, whereby any bank can borrow at a fine rate against government bonds valued at par, no matter what their market value is. And in the case of the Credit Suisse, the SNB was not ready in emergency liquidity. It was able to provide enough liquidity to bring that bank to the weekend, only thanks to an emergency ordinance. That's a law, and it was a law that was not immediately made public, pretty strange to me, by the Swiss federal government, expanding the range of security that the SNB can accept in making an emergency loan. Now, this is partly due to the various attempts by central banks to codify ELA procedures inflexibly over the past quarter century, and that have repeatedly run up against the unexpected. Say, oh, we'll only give ELA if, oh, well, maybe we'll also give it. It leaves them inadequately prepared for needed action. Deposit insurance has once again revealed its deficiencies and the authorities' lack of preparedness in dealing with these deficiencies. When the FDIC took control of Silicon Valley Bank that Friday, they announced publicly that uninsured depositors, those people with more than $250,000, would soon receive the first of several interim payments out of the receivership. Not very encouraging. And then, astonishingly, the US authorities changed their minds over the weekend and invoked a systemic exception to guarantee all the deposits in SVB. And as a result, by the way, the FDIC will take a loss of about $35 billion on this whole business of these banks that failed. And that's actually comparable to the net loss the Irish government incurred in bailing out the creditors of its failed banks in 2008 to 13, which was considered a big thing. So repeated flip-flops on the question of bailing out uninsured creditors of failing banks, these reflect the fact that the coverage rules in existing formal deposit insurance schemes are not politically viable. For example, a sudden bank failure near a salary payment date can make it impossible for even relatively small non-financial firms to pay staff salaries. Since Washington Mutual in 2008, it's an instance that was mentioned in one of the sessions earlier, there have been very limited losses to creditors of failing banks in the United States. Deposit insurance ceilings are not politically viable. Finally, resolution powers. They were almost unused, not quite. And that's despite the elaborate and intrusive legislation that has been enacted to empower resolution authorities to seize control of failing banks and to carve out essential functions while winding down the rest, bailing in wholesale creditors in the process. In the US, resolution planning for Silicon Valley Bank was sketchy, and it did not have anything like the amount of explicitly bailable liabilities, TLAC, that it should have had. In Switzerland, interestingly enough, the Resolution Authority, which is FINMA, had recently insisted publicly that the resolution plan for Credit Suisse was ready to implement, but they shied away from using those powers. Was it a loss of nerve? Was it a prudent assessment that resolution wouldn't really, and they, as they said, have restored the necessary confidence? One way or another, they were not ready with a plan that they considered viable. Interestingly, resolution powers were used for the Silicon Valley Bank subsidiary in London, albeit in a U-turn after a prior announcement that by the Bank of England that it would be liquidated too. I'm afraid that I've had many conversations with policymakers expressing the view that resolution of large banks is too complex to be practical, and Mathias has said the same thing right now. But the whole purpose of resolution was to bring an end to too big to fail. If it's only small banks that can be resolved, like SVB London, then resolution does nothing to break the bank sovereign doom loop. And that's not what the financial authorities promised the legislators. So, conclusion, the US and Swiss authorities actually did cobble together enough action to contain the bank disturbance of early 2023 so that these banks' problems did not spill over into a general loss of confidence with macro-financial consequences. But they did so with considerable improvisation and several missteps. 15 years after the Lehman bankruptcy, some of the world's most respected financial authorities were not ready They were slow to take the needed aggressive supervisory action. They found themselves constrained by unduly restrictive ELA policies. Deposit insurance ceilings had to be overridden, and most disappointing of all, the new resolution tools were scarcely used. So great emphasis over the last 15 years on analysis and planning, and too little on ensuring that the analysis and planning would and could be activated.
Thank you so much, Patrick.
So it's obviously a huge pleasure for me to be here to celebrate the 40th anniversary of CEPR. I would say thank you to the organizers, but I'm an organizer? No, not really. Thank goodness, not this time. But thank you, organizers. So, lessons from the banking crises. We've heard some already. I'll probably repeat some. But let's see. Why did the bank fail? First, get out of your mind Diamond did big. It was quite irrelevant. These were problems of the fundamentals, not problems of sunspots or whatever. So the underlying cause, I would maintain, of the failures was insolvency and not illiquidity. And that's an important point. Did you want liquidity insistence for Silicon Valley Bank, for example? Not if it was insolvent. And it was insolvent. It had been known to be insolvent since September of the preceding year. Marking to market its assets, it was underwater. Credit Suisse also, you have to look very closely at its accounts, but my co-authors and I believe that the underlying accounts show that Credit Suisse too was insolvent in March of 2023. I say in this bullet point the supervisors didn't see it. Well, I think Patrick's right that they did see it in the United States, the Silicon Valley Bank problems, but were inhibited from taking any action for various reasons we needn't go into. But nevertheless, nothing was done. And so what do you need to do? Well, the first principle, and what would have revealed widely and prompted supervisory action, revealed widely the insolvency of Silicon Valley Bank, would have been marking to market those assets that were heavily overvalued by the autumn of 2022. Now, there are a couple of academic papers that purport to show that many US banks are dangerously close themselves to insolvency if their assets were marked to market today. I don't want to go into that, but I think that's probably correct. Now, bank stocks. Bank stocks were hit hard by the collapse of SVB, but they still have higher market-to-book prices than the Europeans do. Patrick remarked upon that. I'll show you some data, which I think are quite interesting. First, what's happened to bank stocks in the US since the collapse of SVB? Well, cratered, okay, and still down very substantially relative to the rest of the market. And funding costs, very interesting here. There is still a big hike of the regional bank funding costs immediately after SVB, more after the First Republic issues. They then came down somewhat, but they are now still significantly over 100 basis points above the diversified banks' funding costs. And that shows you that the markets are not very happy about those banks, and I'm going to say why in a moment. Now, if we look at the euro area, Patrick was, I think, was talking about the valuations. You can see that since just before the global financial crisis, the cost of equity of the European banks, the Eurozone banks, has been higher than their return on equity. And if you look at the orange line, the price-to-book ratios are, 60%, roughly speaking, on average. This is not good. So what do you need to do? You need to raise bank capital requirements. Capital, it has to be stressed, capital is a source of funding, like deposits. More equity would raise lending capacity. Yeah? And that is what the assembled great bankers of the United States denied, of course, in their testimony to the US Congress a couple of days ago. It's worth actually watching some of that. It's hard to believe what they get away with saying. But the lobby is very strong against the Fed's proposals to raise capital requirements. Equity is a buffer against insolvency, perfectly obvious. And if, indeed, Credit Suisse had a 20%, say, capital ratio, it could have survived. Whether you want a bank that had been so mismanaged to survive is another matter, but it could have done. Yes, equity is expensive relative to debt. That's because of the tax codes. But remember, leverage is deadly. And that's what we have to, as from the supervisory side, from the regulatory side, we have to avoid. Sure, if you have capital requirements that are properly risk-weighted, the banks won't lend to activities that have high risk weights. But that's exactly what the risk weights are there for, precisely. Let somebody else take the risk rather than a bank with deposit funding. How to raise more capital? Well, a couple of ways. One is cut executive compensation, cut dividends. Don't buy back stock, right? Oh, the banks don't like that. That will make us uninvestable. Well, you look at where they are now, and you might say, well, yeah, you are uninvestable. Get your act together, right? The alternative is to go to the market. And I think that would be quite instructive. Go to the market. Have a market test of what a bank is worth and what the market thinks of its prospects. Too big to fail. Well, what can one say? There are several bullet points on this slide. There's too much to say about too big to fail. It turns out that even small banks are too big to fail. And that is why the Fed invoked the systemic risk exception. The bottom line is that most banks are too big to fail. You can't credibly commit, the authorities cannot credibly commit to no bailouts, whether that's because of a systemic risk issue or because of the political implications, doesn't matter, right? It ain't happening, it ain't gonna happen. And you can ask, for example, why didn't the Swiss authorities just rely on TLAC? There was a lot of TLAC there. It might have been that Credit Suisse was viable, but they say there was a perceived danger of systemic crisis. But in that case, TLAC doesn't deal with too big to fail. And to go beyond that, most, if not all, of the GSIBs are simply too big and too complex to manage. Even JP Morgan didn't notice their London whale that ended up losing them $5 billion. Citi, and these guys were sitting up, well, this woman, Citi, was sitting up in front of Congress saying, you know, we're wonderful. They had Archegos, okay? They lost only $1 billion there. Credit Suisse, of course, lost $5 billion with Archegos. But they also had Greensill, too. And they were doubtless much less well-managed than Citi, but still, these organizations have gone beyond the bounds of manageability. Resolution of cross-border banks, too, just doesn't work, won't work. National authorities will not accept single point of entry resolution, letting some other authority actually take the role of effectively dealing with their banks. So the bottom line is we just shouldn't have large, complex cross-border banks. You can't rely on supervision. It's very hard to identify risky behavior, very difficult, because a lot can be hidden. the supervisors are paid a lot less than the bankers, after all. And that should tell us something. Stress tests. I have seen in the European Systemic Risk Board many preparations for stress tests, many discussions of the adverse scenario, on which it's very hard to agree because each national authority is worried about its own banks not being able to pass, and so on and so forth. These stress tests simply are not sufficient. And yes, Mathias has said, EU regulation applies Basel III to more banks than in the US, but the internal models that are being used in the Basel III approach are still suspicious. The US still faces a systemic problem, and I don't think this game is over at all. The banks have been losing deposits, the middle-range banks have been losing deposits to the money market funds. Deposits are less sticky than they used to be. But if they raise deposit rates to try to keep those deposits, that would raise their cost of funding above the return on those long-dated assets that they acquired when interest rates, nominal interest rates, were very low. So we have similarities to the savings and loan crisis of the 1980s. At fair value, in those days, most of those savings and loans would have been insolvent, but the zombies were allowed to survive and to gamble for resurrection and to build up more liabilities that ultimately the taxpayer had to meet. Expanding deposit insurance. Wait a minute. If you don't eliminate the zombies first, do you really want to expand deposit insurance? Of course, ex post, you insure depositors anyway, as was pointed out. So do you encourage mergers? It's not obvious that two weak banks are going to make a strong bank. On the other hand, it's not obvious that you want the big banks, the really big banks, to be absorbing these smaller banks. It just exacerbates the too big to fail problem. And so you go back to the fundamentals. The Fed and the Congress should ignore those bankers who are sitting there saying, oh no, don't get tough on us. They should ignore the bankers and make all the banks mark to market and raise more capital. And for further elaboration on these points, there are two pieces that Anat Admati and Martin Helvig and I did in that wonderful CEPR portal, Vox EU. I finished with the commercial. Thank you.
Thank you very much, Richard. So let me take a few minutes to add to a few of the points that have been made, and let me start by telling you about my summer job. This was, one of those typical summer jobs, unpaid, but a lot of work, and it came from the Swiss Ministry of Finance, who put in place an expert group of independent academics and experts in Switzerland to come up with a report about the lessons from Credit Suisse. And the advantage that we had in this context is that we had access to the people who had made the decisions and to the supervisors, both in Switzerland but also across the Atlantic, and all of those who were in the crisis committee. So it was an extremely interesting experience, and some of the results I also I wrote up in a Vox EU column where you can also find the report. But let me give 2 or 3 hints which relate to things that have been said, and in particular to the Credit Suisse experience. First, I think an important point is that in this working group we found what we did not expect, that in fact this too big to fail framework could have been applied for Credit Suisse, that the International Crisis Committee had been working for several months and were in agreement that it could have been applied. Now the question is, what would that have meant? I mean, when we say go for resolution, what does that mean? In this case, it would have meant, in addition to bailing in the AT1s, one would also have bailed in the bail-inable bonds, so the full TLAC. Those were, just to put numbers on it, about 100 billion over a balance sheet risk rated of 250 So you'd have had a Credit Suisse on Monday morning with a 40% equity ratio, risk-weighted. If you prefer leverage ratio, Richard, it was 15% TLAC. So it's not that far away from the 20 that you are advocating, and that's the kind of capital with which Credit Suisse failed. But so why was this framework not applied? Well, because they had UBS as an alternative, and they argued that it was less risky to do so. There is a strong argument that the systemic risks were not, although the FT has this headline, but that was not the main consideration. There are, however, a few obstacles. One of them is international, and the FSB is working on it, has to be work on it. For these bail-inable bonds to make them work, the SEC has to be in agreement. The SEC can't say on Monday morning, well, we will decide in due time whether we agree with this bail-in or not, this conversion under American law. So that is one obstacle that we identified, that has been identified, not just by us. And however, in the case of Credit Suisse, they thought they had it under control. So FINMA had been talking to the SEC extensively, and they thought that would not be a real obstacle. So what was a real obstacle was the fact that there was no funding and resolution in place in Switzerland. The public liquidity backstop had been under discussion. There was a lot of resistance. You have mentioned, I think it was clear, that Europe also doesn't have funding and resolution in sufficient quantity. So this is a real obstacle. That's why emergency law was needed in the Swiss case. So clear lesson for Switzerland, clear lesson for the rest of the world. You need either a lot of ELA and a central bank that is prepared to provide it against not only a very tight set of securities, or you need a public sector, public liquidity backstop if you're going to do any kind of resolution, because you will need to have that security that the liquidity is there. Now, a second point I wanted to make is that I think it's a little bit artificial to say it's, there is just Diamond Dibwick type of liquidity runs and solvency, which is when equity is de facto negative. Credit Suisse did not have negative equity. This is where we have a disagreement. I think when we go deeper into those accounts, it's not, I think, I mean, there are problems. There are problems in understanding what is the actual equity position, because it is trapped in different legal entities, but that's a problem which has to do with the structure of the bank, and it was not. So let me be clear. Some of the capital was trapped in legal entities which are not the parent bank, where both capital and liquidity were needed. But the problem was not so much that the capital wasn't actually there. Otherwise, UBS wouldn't have had a 30 billion profit in the moment they took it over from negative goodwill. The problem was that prospectively, and I think that's where we maybe can get together. Prospectively, there was insolvency in the sense that nobody thought, markets didn't think for sure, because the equity price was going towards zero, that this company's franchise value was still there under current systems management, etc. So that's not but that problem, that there is an issue there. If it is a question of business model and of prospective insolvency, then you're not measuring it with capital requirements on the balance sheet at the time. So those are 2 points that I just wanted to also throw in, and we have a lot of expertise in the room. I can talk about this forever because I've been going around for the Fed. I was just at the Bundesbank. I have all sorts of discussions that we have about what are the lessons. I am therefore confident that we will still keep discussing the lessons for a while. Fortunately, in a time of quiet where we can draw lessons. So I want to open the floor for any kind of comments or questions to any of the panelists. Yes, I thought that Weder was a little bit faster than Nicolas. Go ahead, Weder.
Thank you, Beatrice. I am in agreement with most of what has been said, but not everything. And I just try to narrow my questions to two questions. Indeed. I seem to have understood that Richard was proposing as one of the solutions that full fair value accounting should be used on every items of the balance sheet. Well, I ask if that will not introduce too much volatility, because I have seen that banks, if that would be applied in one moment, they would be close to insolvency, but then 6 months later, or even 3 months later, market values change, and all of a sudden they are again solvent. So I think it's too volatile. I would extend, and I prefer the approach that we have in Europe for that, and in particular with some refinements in what regards the treatment of the held-to-maturity portfolios. I think that there is room to discuss that the size of the held-to-maturity portfolio in relation to the balance sheet should be limited, should have a ceiling. That was not the case in the SBV, for instance. That hedging, mandatory hedging, should be introduced. And what we have in Europe is an automatic stress test every year where the bank has to provide the exercise of recalculating the balance sheet with 200 basis points more on interest rates. And that is automatically done, and it's very important, and they don't have that in the US. But with these provisos, I still resist a little bit to full fair value accounting for everything for this reason. My second question is about the other solution that Richard proposed, which I can understand and agree even, more capital for the banks. Yes. But then that raises the issue of non-bank financial institutions, and I am very worried with what is happening. That sector is increasing a lot in size because they are much less regulated than the banks, as it should be, by the way, up to a degree. But this boundary problem is still not well addressed in my view. And for instance, I referred you to the chapter 2 of the April IMF Global Financial Stability Report, which is about non-bank financial institutions, and what they say in the first page is that there are problems, there are vulnerabilities. Think about money market funds in the US that have to be bailed out from time to time, or open-ended investment funds with their maturity mismatches and all that. There are vulnerabilities, says the IMF, but the solution is for the central banks to open the provision of central bank liquidity to all those non-bank financial institutions. That's the solution of the IMF, not strengthening the regulation of the non-bank financial institutions, but just give them access to all facilities of central banks, which I find a very risky approach. And I am then concerned that if we continue to strengthen the regulation of banks and do nothing in what regards the non-banks, we are aggravating some of the problems with the financial system.
Okay, thank you. I think that was more of a statement.
Yeah, it was.
Right,
no, but it had two questions.
Okay, so shall we take Nicola also, and then maybe you can go on.
So thank you. Let's see if I can use this. Yeah. Nicolas Veron at Bruegel and Peterson Institute. Like many others, I'm sure here, I'm struck by the contrast between what you gave us, Beatrice, and the views from both, particularly Patrick and Richard, on the failure of the resolution framework. I'm not sure it's a popular opinion, but I tend to join you. I think you, Beatrice, I think the Swiss authorities have a very plausible case. There's not enough stuff in the public domain to be certain, but the Swiss authorities have a very plausible case that they had a resolution option ready and that they opted for the transaction with UBS because they thought it was better, not because they thought resolution was impossible. But I'd like to hear a bit more from Patrick on that. What makes you think that it was not that it was that the Swiss authorities couldn't do resolution according to the book? Thank you. And just a remark on what Vitor said. On his first point, I happen to agree. I think it's just to emphasize the point, it's not just volatility, it's also procyclicality. If you have a full mark-to-market accounting, it becomes extraordinarily procyclical at times of market downturn, especially because you raise capital requirements. And I think that's the main trade-off to consider in that particular debate. But back to Patrick.
Okay. Patrick, you want to take the too big to fail, and Richard, you want to comment on mark-to-market?
Yeah. My concern is, so I agree that they were ready. I think they were ready. They thought they were ready. They said they were ready. And Beatrice has confirmed that they were ready, even in regard to the SEC thing. You can never know whether the other authorities, the Bank of England say they were ready and encouraging them to go ahead. I mean, there were the two external, basically it was London and New York. These are it needs to be done. Now, what worries me is if they say they were ready and they believe they were ready and then they didn't do it, what does that tell you about the resolution regime? The Bank of England told the Parliament in London 5 years ago that they would, they were preparing for the large banks and that they would be ready by the end of 2021. And I think they have said more or less that they are ready. They have some sort of qualified statement of being ready. But does anybody believe that? This is my concern. I'm not saying that they did a terrible job in Switzerland. They think the thing was managed reasonably well, but it's alarming to look at the way it was managed. The outcome may have been okay, except for competitiveness problems, but it's alarming to see that this is what's going to happen in the next GCIB. They're going to cobble through some solution which was not the solution that was planned for.
Yep, not implementable for whether political reasons, systemic risk reasons, whatever reasons you can think of. If they were ready, why didn't they do it?
Because there was a better solution?
Sorry?
Because there was a better solution?
Well,
I mean,
do you think, if you really think UBS is a better solution, that may be right. It does leave Switzerland in a rather difficult position, if you ask me. But
easier solution.
It was certainly an easier solution, that's for sure. But on marking to market, that it would create too much volatility and be too procyclical. Well, you don't have to do it every day. You can mark to market every quarter, if you like, even every year. But no, every quarter, I think. Is probably a good number. Limit the size of the hold-to-maturity portfolios, probably a good idea anyway. Require hedging, probably a good idea anyway. I wouldn't object to that. But just after Lehman Brothers, I had a public argument with Larry Summers about this. You don't want to argue with Larry Summers, I can tell you. Whether you're right or wrong, okay, doesn't matter. You don't want to do it. But I was at that time arguing precisely against marking to market for precisely the reasons that you have evoked. But I'm afraid I think things have changed, and the reliance that we place on assessments of banks' capital and so forth, I think it's just not realistic to have assessments of banks' viability that don't mark their assets to market. Now, those, as I say, those don't have to be every day. So that's how I would deal with that issue.
Okay, so now I see quite a few hands. I think, Eric, is it you? Yes, Eric, and then Stein. Let's collect and let's make it a little bit short so we can have several rounds. Yeah.
Yep, thanks. Eric Nielsen at UniCredit. I'm an advisor and I'm just speaking on my own behalf now. Richard, part of my job is talking to financial market participants. If you're suggesting that more capital is needed, I would love to be in the room when the CEOs of all the European banks come around and asking for more capital. The first question is, why do you think we only trade at 60% of books? Because over the last 15 years, the banking sector has been the worst performing sector in the index. What makes you think, Mr. CEO, that you'll be doing better over the next few years in terms of return on capital? And we can go through the variables. I'm going to tell you, yeah, maybe you can cut costs more, I'm sure you can, but that's a hell of a long way. And then on the last point on the Swiss story, the question might also come up, and if there's a problem, how is it being resolved? Laws are being changed overnight, and if I understood Nicola correctly, said maybe there was a justification if everything that happened was public, so maybe there was something else. So I'm not sure if I understood this correctly, but I'm just putting across the point. Would you, Richard, then be willing to clean up the system if the banks just can't raise the capital that you're asking for? Because I just don't think the capital is available on the prospect of profitability for the banking system as a whole. Okay, Stein?
3 comments. Mark to market, I see the main problem in the discretion that was given to banks, and I think we need to take that away and having some rules, as Vita was mentioning, but to do the mark to market across the board, that creates a money market fund. Banks are different. I think we need a belt and suspension approach, so we need a little bit of everything. And capital, I think Basel III need to be completed, obviously, and I'm speaking in my personal capacity, so it's not an official storyline that I'm telling here. I think it's necessary. But you need a little bit of everything, because otherwise you're going to get too much migration, and we're running that risk. Little point on resolution, Patrick, you need to think of a lot of parties, including foreign parties, that were probably willing to tell, oh, just do the UBS solution. It's easier for us too, and it's less risky. And I know some agencies who said that. But my question is really for Mathias in some sense. And I missed it a little bit in the discussion. SVB was a singular case that became a systemic issue because there were other banks similar to that. Otherwise, you would have let the bank go and let these guys in Silicon Valley take the hit. That would have been perfectly fine, of course. But what is too many to fail these days is unclear with these faster runs. All the banks that then become too big to fail. What do we do?
Okay, thank you. So, yeah, what do we do? Okay, what I'll do is I'll take 2 more questions now. Please make it short, and then we'll have a round, because we don't want to intrude into the next one. So, Michaela here, and then it was actually Gaston. Sorry, it was first. Yeah. Huh? No, in your head, not in your headrest, in your armrest.
So I just wanted to maybe following up a bit on Eric's point on the question of profitability of banks. So I'm just thinking a little bit as a foreign investor looking at investing in euro area banks and looking at what happened over the past decade. So we had negative interest rates charged on bank reserves. We had dividend bans. We had a sudden clawback on the LTRO. We had minimum reserves no longer being remunerated, and with proposals to increase them quickly now that banks were becoming more profitable to offset what are perceived as losses for the central banks. Then we had governments, the minute banks became a bit more profitable, proposing higher taxes. Then we have a completely incomplete banking union and an absolutely missing capital markets union. And so when I look at the investment case for foreign investors, or even for domestic investors to look at European banks, I really wonder how strong that case is going to be today. And I think we as Europeans really need to think about the important role that banks play in the economy and how they can play this role. And to me, the first criteria to have strong banks is to have profitable banks. Now, I agree, the banks have a role in managing their costs and doing better, but I do think we need, as Europeans, to look at some of the differences between the US and Europe. And we do a very simple index called Banking Misery Index. So you just look at what's happening in terms of the short-term interest rate, you look at GDP expectations, and you can put in some kind of function on the yield curve slope, be it inflation expectations, whatever you like. And you can actually explain a big part of the difference between the valuation of US and European banks. And I think it deserves some food for thought. So my question to you is, how are we going to make sure that the European banks are profitable? And what can be done outside what the bank managers themselves can do?
Okay, thank you. Now, Gaston, very briefly, please.
Yes, I just wanted to bring up the issue of corporate governance, which hasn't been mentioned. Some people mentioned compensation, which is important, but things like having proper risk management, risk officers reporting directly to the board, independent board members, these have measurable effects on bank risk-taking. And I understand that SEB had very, very poor risk management. These are tangible things that can be implemented, and I think that they should be discussed more. Thank you.
Okay, great. So, reverse order. Everybody gets 1 minute to respond. Pick up on whatever you want to from the questions. And sorry? Reverse order, yes.
Sorry.
You start.
You want, oh. Okay. How to make banks investable? European banks investable? Make them better, or make them fold. Make them bring their cost ratios down. Finally, you referred to cost ratios. If you make those international comparisons, European banks don't come out very well. They haven't done for quite a long time. And I think that's, yes, we should have proper cross-border banking union, absolutely. But we don't, and there should be much more pressure from the banking sector and those who feel that they know something about these things to get it. But yeah, there isn't a good investment case right now. But is that because the business models aren't good enough? Is that because the cost ratios are too high? Is that because there are problems here that might be resolved? And I suppose that's my answer to Eric as well. Effectively, more or less the same issues. So I'll stop.
Just for my minute, since people are talking about the growth of non-banks, I mean, do we have to think about whether we're concentrating too much on banks entirely? It's a shrinking sector. Why do we regulate banks? Because of they're key to the payment system. Well, what about fintechs? They're key to the deposit system. Oh, but the government, the U.S. government's bailing out the deposit system. They're key to credit, but your BlackRocks and your private equity firms, they're growing. So maybe our whole way of saying the reason we regulate banks and not non-banks, maybe that's breaking down entirely.
All right, that's a radical one.
Yes, maybe. On Stan's question about the too many to fail versus just the too big to fail. In a sense, it's connected to Diamond Divig. I do think I wouldn't throw out Diamond Divig altogether. I think to me, Diamond Divig, for example, is the best way to understand the Lehman-based crisis, because it signaled all of a sudden that deposits were not safe, and therefore, boom, even for banks that were solvent, of course, if there is a run, they stop becoming solvent. So the key thing is that indeed even small banks can be systemic, and we have to make sure that indeed short-term deposits are covered, whether retail or wholesale. Because financial instability is much more costly than any bailout in general. Especially if it's well done, it can even be break-even. Of course, that means we need enough capital, a good governance. I mean, we need all these things. Possibly not too many deposits and so on. And by the way, this is equity. This is also junior debt and so on. We started because in the financial crisis, only equity lost money. So everything on Basel was quality of capital, i.e. only core equity. And then since we couldn't go high enough, we moved to TLAC as an addition. By the way, in my view, in Switzerland, one good piece of news is that AT1 was built in. Okay, we should have gone to 100% and not only 90% of equity, so greater hierarchy, but I think it was good news. And by the way, on the issue of is it bad that we didn't resolve, I don't think resolution is an objective per se. The objective per se is to make sure that we don't have an externality where the public sector ends up paying for mistakes by a bank. And therefore, you need to hold accountable management, so no too big to jail in some cases. I'm not talking about Credit Suisse, huh? But in some cases, no too big to jail. They need to lose the money, their stock options and the like, and then equity, and then stable junior bonds. And if that's enough, I mean, I don't know the number, of course, but if, to me, it's not impossible that indeed going for UBS was the better solution, and then it's up to the competition authority to decide whether we should break up that bank. But that's something else, in a sense. But anyway, so that's what I wanted to say.
Okay, just two small points. One on the mark-to-market again. While I am together with Vitor and Nicolas thinking that we cannot apply mark-to-market fully to the whole asset, also because liabilities are not mark-to-market. And in any case, there is the issue of procyclicality, but simple for liquidity reason. When you have an illiquid market, you may have a fire sale, and that would already generate a stability, solvency problem in banks, which we don't want to have. But I am in favor instead of fostering market evaluation and supervision, because investors, in particular in times of crisis, do respond to market values rather than book values. So there, I think, is where maybe rules, supervision, intervention can look more at market values relative to what is now. And then on resolution, I think, I take the position of Beatrice here. I think what's really important is to have a very strong and very clear public backstop. We can focus on bail-in, but we need a public backstop. And Europe is so behind in that we don't really have even the systemic risk exception in the European Union. So the only way we could invoke the systemic risk exception is when a bank needs a precautionary capitalization because of the capital shortfall in the adverse scenario of the stress test. That's not the case of Silicon Valley Bank. That was not the case of Credit Suisse. So I would strongly suggest that Europe introduces and enlarges the possibility to have systemic risk exception and public backstop and support in general.
For liquidity only.
For liquidity.
Okay. Thank you very much. Thank you very much. We have to conclude here because we have more fantastic panels on the way. And just stay in the room.